The number one rule in trading is don't lose money, especially don't lose all your money. But almost every trader breaks this rule with their first few accounts. So today I'm going to show you how to never blow up a trading account with one simple prompt. This prompt analyzes my trades, my risk management, and compares it to the metrics used by professional traders, all in one clean dashboard. And as always, all tools and prompts will be available for free in the description below. Let's get into the prompt itself. Now, this is the Google Drive, which I'll be sharing in the description with the whole prompt. It is currently 15 pages, if we go all the way down. So instead of going through 15 pages just word by word, what I've done is I've created a nice visual so we can go over step by step how I built this prompt, what was the architecture and thought process behind it. And then after we'll go into inputting your own journal and see the actual results that it creates for your dashboard. So the first part of the prompt is actually just inputting your trade journal history. So this could be taken straight from your exchange via a CSV file or even an Excel. What I recommend is having a data sample size of at least 50 plus trades or more, because the lower the sample size, the harder it is to actually gauge your metrics compared to those of professional traders, right? Because the same with trading, how do you know if you have a profitable strategy if you've only taken maybe 5-10 trades? You need a large enough sample size for that. Once you then paste in the prompt, there will be a few questions that it will ask you, such as clarity on what was the account size when you first started, as well as what is your time zone. This just helps with giving you more accurate data when it's trying to find patterns in your trading as well. And lastly, if there are any gaps in the data or anything that Claude is struggling to validate, then it will simply ask you, and then you can decide whether you want to have that data inputted into Claude or not. The second part is the metrics. These are the metrics that we're going to be using when doing a benchmark. And we'll go over what the actual benchmark numbers are for professional traders compared to yourself. So the first part is, going over the net P&L, gross P&L, and then the total fees paid. The reason I put total fees paid is because if you're always marketing into a trade, you're going to be paying more fees compared to simply limit chasing. So that's one simple way to kind of refine your edge, is by limit chasing into orders as opposed to simply always marketing in. Then you have your other basic data, such as your win rate and expectancy. Now, I've spoken a bit before in some previous videos. To me, win rate isn't what I would consider the most important metric. I think expectancy is a far better one to observe, because your focus as a trader is to, maximize your wins and minimize your losses. It doesn't matter if you have a 40% win rate or a 60, even a 30. If you have a good enough risk reward, then that low win rate isn't a big problem. But if you're losing more than you're winning, that's where the problem happens. We also have other data such as your drawdown, which is also one of the most important ones. If you have a high drawdown when trading, then it's going to be a lot harder for you to naturally scale an account. But if you have a very low drawdown, then you'll have much more comfort scaling up an account because your drawdown will still be small. Now, you also have like your Sharpe ratio, your recovery factor. There's a lot of just probably these new terms for you, and that's completely fine. In the prompt itself, what I've done is whenever it's going to give you like a step-by-step breakdown on each of the risk management metrics to those compared to a professional trader, it will also give you a full explanation on what that metric is and give you an actual live example on how to use it. The second category is the actual benchmark itself. So it's going to be your numbers against the professional standard and verdict on the gap. So you can see here, there are 4 classes. You have the performance, the behavior, data confidence, and context. If we look here further down, you can see the actual metrics that we're going to be using for comparison. Now, with the win rate, with the payoff ratio, the profit factor, with all of these things, we're going to have a nice visual that shows you where you are relative to those professional traders. To summarize, there's going to be 4 layers to the dashboard, right? The first one is just analyzing your actual data. The second one is the verdict, which is going to tell you how close you are to those professional traders in terms of risk management. The next part is the scorecard. So this is where you'll be able to visually see how you compare to those professional traders across all of the different metrics that we've just gone over. Then the next layer is the 4 questions answered with charts. So charts is simply going to be a visual histogram to help you understand the data better. It's going to go over, are you actually making money? Where does the money come from? How much risk are you taking? And how are your habits impacting your trading? And lastly, you just have the appendix. So this is just going to display all of your trades neatly. So it's the full trade table, methodology, your scratch threshold. So that's when you're putting your stops break even, open positions, and every sort of caveat that comes to it. So now let's get into actually building the dashboard. So as we said, there's two things that we need. We need the prompt, which will be available in the description below. I'm simply going to copy and paste it from the prompt all the way down. Now it does take some time because it's 15 pages, but once you have that, you simply copy and paste. Then we head over to Claude. I'd recommend just opening a new chat. You can see here, I already have a project with the risk management prompt, but we're just going to type it as a new chat. Then I'm going to paste in the prompt. And once the prompt is pasted, the second thing that we need is your trade history data. So I have a journal that I'm simply going to paste in as well. Once we have both of those things in our chat, we can then start with the next process. When I was going over the prompt, I mentioned how Claude might ask you a couple questions just to give you a better representation of the data. So starting off, we have it asking us what is the time zone, our account size, and there are also for 3, 4, and 5, it did find some sort of discrepancies. So it's simply asking us to confirm whether we want to implement that data or not. And once you answer all of those questions, you simply click send again. And now we can finally get into the dashboard itself. If you're enjoying the video so far, do not forget to like and subscribe to show your support. Starting off with layer 1, which is the verdict. So you can see you made money, but you paid 4,800 of drawdown to earn 1,300. That is not an edge yet. It is a coin flip that happened to land your way. So we see with a net profit and loss of simply 1,338, that is plus 6.7% on 20,000, which is the account balance when we started. The win rate is very good in my opinion, 57.1. That's probably going to be within the benchmark for professional traders. With a profit factor of 1.1, we are positive, but it's nothing spectacular. And then the maximum drawdown is 24%. Considering the risks on these trades were very small, getting a 24% drawdown is very high in my opinion. So it does kind of reinforce the fact that this might not be a valid edge just yet. The second layer, which is the scorecard, is what I believe to be the most important part of this video. So this is now we're going to go over every single one of the metrics, compare that to those of professional traders, and for those metrics where you might not understand how much of a role they can play in your trading, or you've just never heard of them before, each one of those sections will explain to you exactly what it is, how it impacts your trading, and give you a live example of the calculation method. So starting off with the max drawdown, we can see that, the standard is more or less around 10%, and we are at 24%. So with each of these categories, you'll notice a green box, right? That is the box where you want to be more or less within. And if you are further away from the right, then you simply fail that sort of risk assessment. Now, if we want to understand further, what is it? So you can click at the bottom, show the calculation, the reason behind the benchmark exists, and what this means for you. So let's do this for the first example. What does it measure? So maximum drawdown is the largest fall from a previous account high before a new high is reached. It is the single number prop firms care about the most because it measures the worst moment an investor would have to sit through, not the average one. The lower your drawdown, the easier it is to kind of scale your account and to size up. But the larger your drawdown, the more at risk you are of blowing up your account. So if you go to these professional trading desks, that's why they look so much at your actual drawdown compared to metrics such as win rate, for example. And you also have the calculation method at the end based off of the journal data that we inputted. And next you have the worst single day performance. So in this case, we also failed the assessment. Worst single day is pretty self-explanatory. It's the most that you lost in one day. So most of the traders on a professional trading desk will set themselves a daily max drawdown. So you have your max drawdown, but then the daily max drawdown is their cutoff point to where if they reach, for example, negative 4% on their account, they will simply stop trading for the day. And most of the time they'll do like an actual assessment of each of the trades they've taken, whether or not they were part of their trading, did they deviate from their plan? And if they did deviate from their plan, then it's why did they do that? And then it's just improving for the next day. Now let's get into some of the metrics that we've actually passed. So the first one is expectancy per trade. Now, I spoke about how expectancy to me is a much greater metric than simply win rate. But even though win rate as well meets the standards, let's get into the expectancy. So our current expectancy is around $20 per trade across the 68 trades that we've taken. So we can see here that it actually meets the standards, right? Because it's in that sort of green bar. If you want to understand further what this means, you can simply click on the plus icon and you will see here. Expectancy is the average dollar result of one trade, wins and losses blended. It is the number you multiply by trade count to project a result. And then it's explaining to me why this matters for me. So at around $20 per trade, my edge is real, but it is very small. It also sits inside heavy noise, so the standard deviation of your trade results is far larger than the mean, which is why the equity curve swings so hard. Expressed against risk, you earn around $20 for committing nearly $5,000 of margin, and that's at a 0.4% return per trade. So as we've seen, there are instances where you meet the standards and others where you fail. And this instance, let's have a look at ones where we actually are borderline. And that is with our Sharpe style daily ratio. So this is telling me that my mean day is $36 and my standard deviation is around 500 across 37 trading days. I am at 1.16 of a Sharpe ratio, and the standard is 1 or more. And a strong one is 2 or more. So I am just borderline within it. Now let's say I don't know what a Sharpe ratio is. Let's have a look. The Sharpe ratio measures return per unit of volatility. Here it is built from daily realized profit and loss and scaled to a year using 252 trading days, so it's comparable to published fund figures. A Sharpe near 1.16 would be respectable for a fund. It is not trustworthy at 37 days. So at least it's telling me that I would need a much larger sample size and more trading days to get a more accurate representation. And the list just continues. So for my realized risk per trade, I'm at around 2.1%, while the standard is around 0.521. When you're over risking, that just increases the chance of you eventually blowing up an account. So it's like, if you want to stay in the game long enough and you're trying to just survive, you need to be able to meet those criterias, as that will increase the likelihood that you can continue to trade and eventually get to a point where you can scale up and start trading with more size. Next, we have trade frequency. So we actually meet the standard. Now, I had the pleasure of talking to a journaling company, and one of the statistics that they explained was that the more people trade every single day, the lower their win rate and profitability. But it's those who are able to be very selective with their trades and only take a few of them per day with strict rules, such as the daily max drawdown. Those are the people that saw the most success. And then you can take it a step further and understand at what times of the day are you the most profitable, and only focus on those specific sessions instead of just trying to trade every single session. The final layer is simply the analysis. So this just kind of shows me where I'm specifically making my money. It also shows me my P&L curve. So this one in particular is a very interesting one. Normally you want to see a nice and steady curve to the right with like minimal drawdowns. You can see with this P&L curve, it's not a good representation of someone who is consistently profitable. So let's actually see where the money is coming from. So from 5 trades and from the long side, your losers are larger than your winners. So we'll see here that the ghost is what a professional ratio looks like. So that's going to be that dotted line. And we can clearly see that with an average win of $346 and an average loss of $411, our average win is in fact lower. So the point it made that most of my wins came from just these outlier trades is telling me that, maybe my edge isn't really consistent. The next data point is that I have more winners, but my losses reach further into the tail. So what this is simply telling me is that when I'm winning trades, I'm actually sizing up smaller compared to my losses. So my losses have a much bigger impact on my trading account, hence why the average wins is lower than the average losses. And this is just a better representation of what I just spoke about, which is how much risk are you taking? And you can see that the distribution is relatively bad, right? The bigger you size, the worse you did. So while the first part of the dashboard just compares your trading performance against that of a professional trader, the second part of this dashboard kind of goes deeper into, okay, what are the things that you need to be aware of for you to then tackle them and improve them in your trading? Because that's something that I don't see with most journals. It's like most journals just simply tell you like, okay, this is your data. But how many of them actually give you a full breakdown in, okay, this is where you really need to focus on, and these are some suggestions that you can do. So there you have it. One prompt, one dashboard, and a full assessment of your trading based off of risk management metrics compared to professional traders, as well as giving you feedback on where you can improve your own trading. If you want access to the prompt, then just click on the resources link in the description below. And as always, if you have found value in this video, please show your support by liking and subscribing, and I'll catch you all in the next video.